Is there an easier way? See what I'm saying? I'm having to spell out the email address like 5 times. Just need something simpler to be able to tell people. Hello. Sorry, we had some technical difficulties earlier, so we're going to try this again. Just bear with us just 1 second. Welcome to Mark's 10 at 10. All right. Welcome to Mark's 10 at 10. Thanks for hopping on. Those of you who are here, those of you who will be here, and those of us who are here are the ones that are supposed to be here. So, the big headline today, Wall Street Journal, economic growth defies expectations. So, what does that mean? Well, the economy is still on fire, in short. And anytime we have stronger economic numbers, it hurts mortgage rates. Um, the reason why is because mortgage rates follow inflation. Because mortgage rates are dictated by bond traders who are betting that the economy is going to do either well or good, because their trade is dependent on, they're betting on whether something's going to advance or something's going to retreat. So it's just involved with trading. So yesterday, Federal Reserve, Jay Powell, decided to raise expectedly. Everyone, it was already baked into the mortgage rates. So even though mortgage rates jumped a little bit yesterday, it had nothing to do with the Fed raising 0.25% on the federal funds rate. So just a quick little lesson on how rates that the Fed affects works. Federal funds rate was 5.25%, and it was raised to 5.5%. The federal funds rate, that's the rate at which banks borrow money from the government. Then they turn around and from the central bank, and then they turn and they lend it out in the form of a prime rate to consumers. So consumers with home equity lines of credit, car loans, credit cards, all those sorts of things, those are often tied to the prime rate. So the prime rate went from 8.25%, right, to 8.5%. So if you have a home equity line of credit, your payment just got a little bit more for next month if it's based on the prime rate. And likely it is. This is the 11th raise since March of 2022. Powell did leave room in his statements for the possibility of more rate hikes. However, investor sentiment really is that we're done. So hopefully we are. Pending home sales rose. That is very important. We're still seeing builders very strong. It's actually probably cheaper right now to buy a new home than it is an old home, is kind of the short way to say it. So new home sales are really kind of propping up the market right now. Builders are doing well. New home sales are jamming. Somebody said yesterday that, hey, they're seeing people, contractors that are maybe not working as much. This was a comment that I had on TikTok. I'm not seeing that. We work with builders. All you have to do is open up the publication, and you'll see that builders are on fire. So much so that they're not. Some of them are stopping giving the incentives, closing cost incentives. They're still out there, plenty out there. So if you're thinking about buying a home, maybe you look at new homes right now. Get a new home at a lower price, possibly than one that's already established in a neighborhood. So this really depends on what you want. Um, these home builders are just more willing to sell affordable smaller houses and tap into that demand from frustrated buyers, especially the entry level. So even though mortgage rates are hovering around 7%, maybe a little less on a 30-year fix, maybe a little more if your credit score is below 700, homeowners are holding on to homes financed at low rates, and it's really squeezing the supply, keeping prices at high levels. Now, here's something interesting. Jay Powell yesterday made a comment where he referenced this new, um, there's going to be an influx of inventory coming onto the market in terms of housing. And it sent all of us wondering, what was he talking about? And the only thing we can figure, because the communication sometimes is patchy, is that he's referring to apartments. That is true. Apartment, along with a lot of commercial people finance these commercial loans on products with banks, and they do them on loans that reset. They come due, and you got to refinance it, reset it, re up every maybe 4 or 5 years. Well, now those rates that are coming, those payments that are coming due, and you're going to be resetting, your payment's going to double, maybe 2.5 times. And so that's a problem. Now, maybe not able to meet their investor obligations, and they're going to sell. So you're going to see some massive sell-offs in commercial realm. There's going to be a lot of opportunities out there in the commercial world. That whole market's going to reset, like in a big, big way. So you're going to see a lot of these buildings, like downtown LA. A lot of these they have like 50% vacancy in office buildings. A lot of that's brought on by the fact that in COVID, people started working from home, and now after COVID, these companies sort of rethought how their business works, and they can actually allow their employees to continue to work from home. And so, guess what? They don't need to be paying $20,000 a month for an office space. They don't need to be paying 50,000 for office space, and or 10,000, whatever the space is. I mean, if you got a whole floor of a building, it can get way, way up there, right? So that's very important as we navigate through these times. But it's important to separate that from what's going on in really residential housing, meaning single family residences. There's a massive shortage. We have all of these millennials that are on the side waiting to buy a home. The most people in history that are the age 33 right now. And 30, why is 33 a ripe age and an important age? Because that is the age with which most people start entering into the market in droves to buy homes when they've sort of established. So it's just the data, it's the analytics on it, are that age group. So that just right now, this year, we have so many people aging up, and we have just a fraction of the homes available for those people. So imagine four people fighting over one home. That's kind of what you got. You've got one home available and four viable buyers. And some of those buyers, maybe two of them, two and a half right now, are just saying, you know what, I don't like the rate. I think the market's going to crash. Um, just haven't. Some of them are trying, but they're just not able to secure it. They've gotten maybe um, their momentum crushed just because they're disappointed because they tried and swung and missed on several offers. And so that's difficult. And after you look at 20 houses and you make offers on 10, it's out. Sometimes people just say, "Hey, I'm just going to pause." I mean, especially during school year. So right now, remember, things will slow down. You're going to see a downtick in August. It happens every single year. If you look at historically when housing it goes up in the spring, it goes down in the fall, up in the spring, down in the fall, down in the winter, back up in the spring. So fall and summer is when Americans get out buying homes. That's going to be March to June to July. Uh, that's when a lot of the activity takes place. You're definitely going to see an uptick. That's normal. Uh, Parents, mothers, they want to get their kids back into school, and they don't have to be out looking for a home, worrying about getting their home ready to live. Then it will sort of rebound as we move into winter, move through winter, and back into the spring again. So keep that in mind. One of the things I talked about was the fact that rates right now are really the primary driver for the mortgage, sorry, for the housing industry. When rates go down into the fives, we're going to see a massive influx so of people that are entering into the market. And even though rates are around 7%, when they go down into the fives, behaviorally speaking, that's when Americans move into the market. And Lawrence Yun, our Associated Realtors chief economist, yesterday had a statement that made a lot of sense. and the recovery has not taken place. The housing recession is over. He said, given the opportunity, the ongoing job addition, any meaningful decline in mortgage rates would lead to a rush of buyers later in the year and into the next year. So if you here's the message for you right now, those of you who are in the market looking to buy a home. If you're not, this message is for you. If you are thinking about, and you're one of those people that are struggling and you're frustrated, or you're about to end because you've been swinging with it, or you are just about to re-enter the market or enter the market for the first time. When these rates come down, prices will go up. You might get a better rate, but the price is gonna offset it. So what is the lesson to be learned there? In all the cycles in my 26 years, I can tell you what happens is that when the rates go up, the prices go down. So you're gonna get a better actually a better price. I know it's hard to imagine, but this is the new normal. Um, we have such a low amount of inventory. You're talking about basic supply and demand. Um, Foreclosures, delinquencies are at all-time lows. We've got people adding jobs to the market, companies adding jobs to the market. We're not seeing massive, massive layoffs. Um, and even any massive layoff is still not going to make the flood of inventory that is going to meet the demand for the millions of millennials who are sitting on the sideline that need to buy a home, who will buy a home. And if the rates are 6% or 6% or 5%, they're going to buy the home because they got to have a place for their family to live, and they may as well own a home rather than paying rent. So one of the other topics I'll leave you with is this idea of being able to talk about a loan that is not really dependent on mortgage rates, chasing mortgage rates. And I want you to really just take a moment if you have time today and look up the website allinOneLoan.com. So all in one loan, that's four words, all in one loan, allinOneLoan.com. And that is a proprietary privately held product we house on CMG's books. We lend in all 50 states, 49 states, except New York. New York's the opposite for a lot of us. But this product I travel around speaking about is a little bit higher barrier of entry. You have to have 10% down. But the bottom line is this: you pay your house off faster without changing your spending behavior. And the reason why is because it has an integrated checking account with the mortgage. So it has a sweep account. If you Google the phrase sweep account, or you Google money merge account, you'll see that these types of accounts have been around the globe for decades. We pioneered bringing this product to market in 2005. And what happens is that all of your deposits that go into this new checking account automatically sweep at midnight. They pay down your balance of your loan, $500,000. If your net deposits are typically $10,000 on the first day of the month, your balance goes down to 490,000. Well, if your bills are only $8,000, and you should be spending less than you make, and I get it. Right now, some of us are we're barely making it. Maybe you're going backwards a bit, and you're trying to make some adjustments. And I feel for you there. But for those of you who do have some margin, there's a better way to borrow. We've never had a delinquency on this product in the history of the product. We've never had a default. That means no one has ever been late. It means no one is certainly at fault that it's impossible to default if you've never been late. And so it's a very, very powerful financial tool that many, many people use. We close about $100 million per month across the country with this product. It helps a lot of people achieve a variety of opportunities to mitigate massive mortgage interest that's been predetermined 30-year fixed rate. We do a lot of refinances with it. About 60% of the product of the loans that we close with this product are refinances. The other 40% purchases. You can buy a primary, secondary, or investment property with this product. It's a fantastic financial tool that combines a 30-year draw, first position home equity line of credit, the only one in America with a fully integrated checking account. So allinOneLoan.com. If you'd like some information about that, you can reach me. My email address is Team Neely at the letters, 5 letters, CMGFI. CMG is for Chris Matthew George, our owner. The FI is short for finance. So look forward to hearing from you. Have a great week. Thanks for listening. And as always, see you.